Hey folks, it is no surprise Canadian REITs are getting absolutely devastated, crashing in this current market cycle. And as we head into this next earnings period, it's really going to give us some insight in how these interest rate hikes are going to impact these REITs. We're going to be taking a look at a broad sector of them, whether it's industrial, retail, but I really want to focus on one REIT today that is yielding well over 10%. If you guys are dividend lovers, if you're looking for that juicy passive income, now is the time to start paying attention. I'm going to show you what I look for here. So that's a conversation you can appreciate. Hit that like button, folks, because the first thing that I'm doing right now is going into Yahoo and pulling up their stock screener and analyzing the real estate sector here in Canada by primarily just doing the region as Canada, small, mid, large, and mega cap REITs yielding over 5%. Currently, there are only 41 results. I love the way it starts from the largest cap REITs and it works its way down, but almost all REITs right now are trading well below their NAV price. But it's also intriguing to look at the 52-week low on the right-hand side because almost every single REIT is trading at its current 52-week low. So I pulled some up because, like I said, I want to focus on some particular ones because we all know our RioCans and our Smart Centers, Allied Property, HR. There's a lot of good REITs that sit at the top, and I'd always recommend working with the mega caps first and foremost. But the data that's making me so intrigued by what's going on in the real estate sector is as real estate itself corrects, we're also seeing a really big spike in rentals. The cost of rental income, whether it's office, commercial, or just residential, and we get that from the market stats coming out of the TREB, the Toronto Real Estate Board. I'm going to scroll all the way down to the bottom. I've analyzed this data a lot when it comes to the Canadian real estate market, but today I just want you to focus on a few things. If we take a look at condominium rental stats, we can see that a one-bedroom apartment year over year is up 20%, but the total new listings is down almost 30%, and the total apartment rentals is also down 11%. So there's a supply and demand problem right now where there's not enough rentals on the market, driving up the total cost of rents. But that's just from the rental stats for condominiums. But if we scroll up and take a look at the office, which is what I find really intriguing as well, commercial stats, right? So the average office lease is up 17.5%. And I'm always going to be presuming that office real estate is dead. That's how I felt since the pandemic. If you go to places like San Francisco, where I just visited, it is crazy the amount of office space that's available for lease right now. But somehow here in Canada, the office lease rates have been going up, which means there's still some competition there, right? And taking a look at the average industrial lease rate, so this would be more in pertaining to things like Dream Industrial or Granite Real Estate, we can see that it is up 20.3%. So what I'm going to be very focused on is, are we actually seeing rental increases? Because though the REIT is crashing, though their assets, the total value of those real estate properties is coming down, presuming we're only looking for dividends and that juicy passive income, this is data that is going to really matter. So first and foremost, I'm going to be watching Canadian Apartment Properties REIT, Canada's largest apartment property REIT, just to see what happens here from a rental and residential standpoint, because this thing's down 31%, but the yield to me doesn't get me excited, right? This is a growth REIT, so I need to see some growth from that rental income. Now, the reason I only own two Canadian REITs, being RioCan and Smart Centers, is because not only are their yields very attractive, I think these REITs own pretty much the most premier real estate in all of Canada, primarily fixated in Toronto, where there is no more building really. We're only building up. I kind of call them monopolies in their own sector, and this is something that on the RioCan earnings they mentioned a lot, that there will be no retail malls coming up in Toronto. That's done, and that square footage is massive. In worst case, tear the malls down, build condos. There's a lot of opportunity here, and the ex-CEO of RioCan came out saying that they're actually seeing an increase not only on the lease rates for that retail leasing area, but it's just they're really hot spots because there's just no malls, right? So Smart Centers and RioCan I love because they're anchored by these incredible tenants like Walmart, Loblaws, Canadian Tire, Sobeys. So this has been my place of solidarity, the only REITs that I'm cost averaging into as it stands today. I have these REITs set up on drips, and I'm going to keep buying them, but I'm trying to find comfort in one other REIT. I'd like to own at least 3 or 4 REITs, and I'd like it to make up about 10% of my entire portfolio because it's something that I lack, and it's a place where I trust the rental income. But what I'm looking at right now is the industrial sector with something like Dream Industrial or Granite Real Estate Investment Trust. And again, these aren't paying the highest yields, right? But Dream's right now paying a 6.63%, Granite paying a 4.7%, but I really need to be paying attention because there's such a large amount of competition in the logistics center. Those REITs related to logistics, when Amazon was just pumping these things to the moon, Granite and Dream both have Amazon as a tenant, and something tells me these REITs, their growth vector was based off the explosion in e-commerce, which now might be slowing down. So I'm going to be very much paying attention to what these earnings look like because again, you take a look at the year-to-date chart, if we can get that to work there, guys, these things are getting hit massively. But again, that could estate to a buying opportunity, and it's something that would greatly diversify diversify my real estate portfolio. Now, this one REIT that is yielding around 10% that a lot of people in my WhatsApp group, something I've paid attention to for a while, but has actually been posting really good numbers that I wanted to uncover, is True North Commercial REIT. Now, this is kind of a mid-cap sized REIT trading well below its NAV price. I think they're managing over around $1.5 billion of real estate, currently worth only $555 million, with a 9.67% starting yield. And on those last earnings, guys, they crushed it. And I wanted to uncover why. Why is this REIT doing so well? And I avoided it pretty aggressively because it's a pure office REIT. I mean, a pure play to office, right? Which I just don't see office being somebody that has kind of adjusted to the work from home lifestyle. I just don't know why office would be doing so well when personally what I see on the streets in the US, like San Francisco, there's just offices are, vacant everywhere. But in Toronto, maybe it's a different story, and we're going to try and figure out why. So they have 5 million square feet, 47 properties, 5 provinces. And again, they're sitting around $1.5 billion in assets. And just diving down into this, guys, take a look at some of these properties. They are spread across most of, Canada, a lot in Alberta, British Columbia, mostly fixated in Ontario, which is again something that I appreciate because I like having a moat in my real estate properties. And they're not nearly as resilient locations as something like a Rio can, but you're still getting areas in Markham, some of the areas around the airport, and those are still good growth areas. And I talked about why the Toronto real estate market, because of the green belt and other limiting factors, have driven the value of real estate so astronomically high. But just taking a look into this, guys, they're claiming they have a 96% occupancy. 76% are government and credit related tenants. And this is where I get very intrigued. Their tenant basis is primarily, 35% is just the government. And this is something that I'm trying to wrap my head around because I have been dealing with the government, the CRA, on a multitude of levels. And even the government has started to adapt to that work from home lifestyle. And this is something that I'm going to be highly fixated on in this coming earnings report, because when 35% are government tenants, I don't think it gets more stabilized than that. And take a look, the federal government is their number one tenant at 13.7%. The province of Alberta, guys, 9.9%. They have TD Insurance. The province of Ontario. These tenants, I don't think you could ask for more resiliency from. I mean, there's just, Walmart doesn't even compare to the federal government of Canada. And I'm curious to see the stability and just how they kind of continue with these tenants moving forward. And it's something I'm going to pay attention to from a base rent place, because again, when I'm talking about the leasable office space going up in value from a rental standpoint, I'm not actually seeing it on True North Commercial REIT's balance sheet here. Because if we take a look at base rent here, guys, and this is why their earnings are so convoluted, because they've been selling some of the I think they actually had a little bit of exposure to logistics, but I read through a lot of the reports and I've noticed that for that, that second quarter area, they were selling some of their properties off, which led to higher revenues for the quarter. And what I always recommend you do is come down into the base rent. We just want to know what their tenants are paying them and if that value is going up over time. And so long as that value is going up, I'm 100% for any of these REITs. But the problem is from June 30 for the 6-month end, we're actually seeing a slight decline. Nothing major, nothing to get worked up about. But again, in an environment where lease rates should be going up, I want to see that material impact, especially on the next quarter. It's something I'm going to fixate on, because quarter over quarter from last year, guys, we've actually seen a decline, a little bit of a decline by $500,000 in base rent. And the other thing that's interesting about this REIT is it looks like they got into parking and other. So it looks like they own some parking lots, probably around the buildings. Maybe they started charging for that parking. And we can actually see that they've done excessively well, seeing a rapid increase into the millions when it comes to making money off parking lots. So it's a bit of a growth vector for them, but considering it's an office-based REIT, I don't want to see their growth value derived from parking. I'd much rather see it from this base rent going up over time. So this is stuff that you're going to really want to pay attention to, and what I'm primarily looking for out of TNT, which is the ticker for True North Commercial REIT. But I hope I offered some insight into what I pay most attention to in the real estate sector, and I'll be making more videos as these earnings drop, so consider subscribing for those updates. But what are your favorite Canadian REITs and why? I'd love to hear about it in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.